Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again David Jensen. Welcome, David.
Good morning, Jay.
You know, we talk almost every week about the virtual markets as opposed to the real markets for gold and silver and platinum and palladium. And you've noticed some real discrepancies between the two, especially in the platinum and palladium space. Palladium being the most pronounced. Where do these markets stand now? The real markets for the metal, as opposed to the virtual markets, the futures markets that are in the United States and England.
Yeah, the silver today on the Shanghai Gold Exchange is running about a 98-cent premium, or 4.7%.
Wow.
Yeah, and it's gone up from about 2.5% about a week and a half ago. Platinum is $84 an ounce, or 5.6%. And then finally, palladium is $142 an ounce premium, or 16.1%. So palladium, when we first started looking at it at the beginning of July, was running about $125 an ounce premium, and it's now gone up to $142 an ounce.
You know, David, what it just keeps the question that keeps popping up in my mind, and I know I've asked you before, but I just can't quite understand why, if these kinds of discrepancies last for any length of time, why some enterprising treasurer of one of these platinum palladium companies won't start selling their metals, delivering them physically to China, to Shanghai, to take advantage of this spread.
Yeah, I'm not sure that it's the mining companies themselves that need to adjust where they're pricing their metal in the near term. It should just be the market for the metal would have the metal flowing to where you can get the highest price. Certainly, the mining companies have historically priced off the LBMA, and that takes a little bit of time to change. Mm-hmm. But surely, if the metal is out there, it should flow to the high price area where the need is the greatest, mm-hmm. and then extinguish these premiums. So I certainly agree. I do think, Jay, that the Shanghai Gold Exchange for gold and silver, and then the Shanghai Metal Exchange in particular for platinum and palladium, may be very valuable portals for us to look through to see prices for metals which aren't in the hands of the regulators, being the central banks, and platinum, palladium, and silver certainly fit those bills, fit that bill, and I would expect these prices to spread to other physical markets with time, and I think it should be a fairly short time.
Yeah, you would think that arbitrage would set in unless there are some restrictions. Government restrictions to trade or selling metals there. I don't know. I'm not well versed enough to know. But there must be something going on, because it seems to me with that kind of a spread, $142 per ounce on palladium, that somebody would try to profit from that if they could. So
yeah.
must be something standing in the way. It was just a question for me. I don't understand, because if you have free markets, you don't have that kind of discrepancy. Of course, who's saying that we do have free markets these days, right?
Yeah, and I know of no import restrictions on palladium and platinum in China, especially given the fact that China has no production of that metal itself.
Right.
So it needs the metal, so you wouldn't throw up import restrictions for that.
Mm-hmm.
You would want to bring in as much as you can.
Yeah. Very interesting question. I would think maybe it would be a question for Eric Sprott or somebody like that. To see what they have to say.
Yeah, I would just follow these three prices with time, and then this may be, the initial signal of a switch of the metals in the physical markets, of the real metal price starting to have a different price structure than that in the derivatives or the virtual market, which is New York and London, and it may be the starting of the parting of the ways between these markets, and certainly with it occurring at the same time that there's so much question about the petrodollar and also the geopolitical strife that we see, these types of price imbalances would not be unexpected, and they may well be associated with the other issues at play.
Yeah. Well, you noted that there's the silver manipulation lawsuit gained some coverage this past weekend from Bloomberg and Reuters. What can you tell us about that?
Yeah, goldcore.com, Marco Burns' website there has covered this, identifying that Bloomberg, Reuters, and others are starting to give attention to the silver manipulation lawsuit, which has been filed against the three banks, HSBC, Scotiabank, and one other. And what I find of note there is that when we look at this lawsuit, again, they are focusing on patterns of trading near the fix and discrepancies during the day. But the issue to me is one not so much of the derivatives manipulation, which you would naturally expect with our market structure, but the market structure itself. And the fact that what they are trading is not metal, they're trading what commonly referred to as derivatives, but they're really digital virtual instruments which can be created without limit. And because you have these items being traded in the market, it lends itself to manipulation. It guarantees manipulation. So, again, we just seem to be focusing on, with this lawsuit and the coverage that it's receiving in the press, we're focusing on individual banks and their patterns of trading derivatives. And the issue is really a much greater one, is that we need to return to a real market where the asset itself is priced by the purchasing and sale of the asset itself.
Yeah, does it get to the issue of naked shorting, in a sense? I mean, there's nothing you wouldn't want, David. You wouldn't want regulation that doesn't allow short selling, would you?
No. If you borrow an instrument and sell it, that's fine.
Yeah.
But what's going on here is that the instruments they're selling are virtually all of them are naked.
You're right.
When you have 100-to-1 leverage in the LBMA, almost every instrument you write, except for 1%, are in effect naked. So, and that is the great disruptive mechanism for the market, and it really goes back to when you suppress gold and silver. It goes back to the whole issue of interest rates, and we can see now with time and looking back, the great moderation of the 1990s, and finding out that the CFTC gave special dispensation to Goldman Sachs division J. Aaron and Son, who are gold traders, to enter into the commodities market and to really play in markets of which they had no assets themselves. So they could basically go in there and just start manipulating those markets for their benefit. But the greatest benefit that came from manipulating gold and silver was not in the trade themselves, but it goes back to Gibson's paradox. And the issue is that if you suppress gold and silver, you suppress the appearance of inflationary signals, and it allows you to force interest rates down. And this, the Wall Street Journal started writing in the late 90s about the quote-unquote great moderation.
Yeah.
And we know what's going on here. Gold and silver aren't going anywhere, and inflation, as measured by the government CPI index, isn't going anywhere, and they surely must have mastered this, right? And so it was just basically it was a big con job, and at the center of it were players, Alan Greenspan and Robert Rubin at Treasury, and Robert Rubin, of course, came from the chairmanship of Goldman Sachs, which was right in the middle of all this. So, we really have to see that that the fix that we're in, or the pickle that we're in today, with the bond market being as large as it is, at over 300% of global GDP and $200 trillion in global debt outstanding, came about because of the suppression of the inflationary price signals, the signals that would come through when the banks were running loose interest rates. And those primary signals were really the CPI, which was manipulated through the Boskin Commission, and then it was also suppressed. The signals were suppressed by containing gold and silver prices.
Yeah, indeed, and it was Lawrence Summers that wrote the paper on Lawrence and Summers and another academician that wrote the paper on Gibson's Paradise, explaining the relationship between interest rates and the gold price. And now, if you're going to suppress the interest rates, you had to suppress the price of gold as well. So I'm convinced that's what they've been doing for many years. I guess it gets to this whole notion of, well, Taylor, you're just a conspiracy nut. But but actually, I think there's plenty of evidence out there, and we're going to be talking. In fact, at the first hour today, we did broach this subject with Chris Powell on the show.
Yeah.
But I don't think it's. I mean, there's plenty of evidence out there that this is going on. Certainly, the major bullion players have unlimited amounts of dollars, and they're in those gold markets, and clearly keeping the keeping the price mechanism from working. If you see this smackdown that occurs just at the right time in many instances, a lot of times when you would expect the gold price to really take off, it goes in the other direction, and then you find that there's one or two of these big major bullion banks that were in there selling ungodly amounts of going forward, selling short ungodly amounts of gold to drive the price down. So I think the Ghana people have made, I think, an awful lot of progress in at least providing circumstantial evidence that the gold price has been suppressed, or a lid has been kept on it. I think it was Larry Parks that said one time, Jay, if they could ship all of the gold to the moon, they would do it. So they'd like to keep the price of gold at 10 cents if they could, probably. But the point is they can't. So within limit, I guess the main thing is to manage expectations and to keep people positive and happy about the fraudulent dollar, right?
Yeah, I mean, you had a Freudian slip there. You said Gibson's paradise, and I think that might.
Did I say that?
Yeah.
Well, it's a paradise for the guys that are manipulating the system.
Absolutely, it really was a paradise for them, because what the derivatives market allowed them to do, in the way that the LBMA gold market was changed to have these unallocated instruments traded, and the COMEX became increasingly a paper market. And the banks could go in there and play, as long as the banks could suppress interest rates, they had limitless ability to juice the markets. And so there's been trillions of dollars have been extracted, and there's been a number of studies of the costs of the 2008 crisis and afterwards, and I've seen estimates over $25 trillion now, and that's the cost that everybody pays from their pockets. So, to say that I guess you could say that it supports the petrodollar, but to some extent, but what it really did was allow a limitless extraction of wealth from the greater society.
Yeah, from the middle classes to a great extent.
Yeah.
And the parasitic top 1%, primarily. I mean, I don't want to take away from people that actually do create wealth. There are a few here and there, but most of it is just legalized theft through Washington, which continues to grow. The monstrosity of the bureaucracy in Washington, D.C. If you've ever traveled down there recently and you see, all these new buildings going up, government bureaucracies that I think really control, as much as anything, control policy going. These are guys that influence Congress and actually own the Congress, in my view. Well, so we're in a pickle because we've decided not to let free markets work. We've allowed the Keynesians to take over, which I think I like to refer to the Keynesians as communist light, essentially, and I don't think they're even that light. I think they're, instead of ruling over us with a barrel of a gun, they'll rule over us by manipulating our minds in the markets and keeping us confused about what the truth is. But in any event, Argentina is flaring up again, talking about countries that keep their people down on the mushroom farm. Argentina is preparing, looks like they're getting ready for another global default in the debt markets.
Yeah, they're turning their backs, it appears, on the hedge funds, which had won a decision post the peso crisis of 2002, 2003. And the hedge funds held out, and there was a decision a week or two ago by a U.S. court that indeed that the hedge funds were due their full value of their bonds, and that's now flaring up. They've got a July 30 deadline, and we see that the credit default swaps are taking off in price on Argentina. Mm-hmm. So it's very difficult to tell what's going on here, but it certainly does appear, as you noted to me, that Argentina appears to be distancing itself from the West to some extent, and ready to walk away perhaps from some of the old strictures which were in place using the IMF and others, who've in the past contained them and forced them into certain patterns once they were indebted.
Yeah, indeed. And in fact, I know I read somewhere, and I can't remember exactly where it was, that that Argentina has actually requested to be a part of the BRICS. So I don't know. I don't know if that's going to happen or not. But I think Brazil was in favor of it, and India might have been, but a couple of the other countries were not.
Right.
Had not yet come out in favor of it. But clearly, Argentina has really not been shy about letting its feelings be known about the United States and what we've been doing around the world through the IMF and so forth.
Yeah.
Another issue that you brought to my attention, the Swiss and China currency swap agreement between the central banks. Talk about that, if you would, for a little bit.
Yeah, it allows them to exchange currency, and it looks like what they're doing is setting up tools and devices to allow direct transactions between those countries. And the U.S. dollar has been used as the primary transaction mechanism for a long time now. And, this is another, we've seen these types of agreements between, Germany and China and the UK and China. They're getting ready to put up facilities to allow transactions. So it just looks like this de-dollarization preparation is being put in place. All these countries are getting the mechanisms prepared to give them alternatives for some kind of a currency crisis.
You think they're fearful of a dollar collapse potentially?
Yeah, possibly a lot more concerned than Obama is on the golf course.
Yeah, well, you would think that Obama hasn't a clue about that. That he's, I suppose, he thinks his military can always go around the world and force people to use dollars, and we're superior. American exceptionalism, and whatever that means to Obama. I thought our country once was exceptional when we tried to follow the Constitution, but since this guy and previous presidents have basically, I think, thrown the Constitution out the door, I don't think we're exceptional anymore at all. In fact, I think what we're doing is America is becoming like everybody else, a socialist country of a bunch of parasites that look to get something for nothing. And if there's any sure way to destroy your nation, it's that way. But it's very interesting. There's so many things going on now, David, that really seem to suggest, as Jim Rickards suggested on this show a few weeks back, that he thinks the process of moving towards a currency crisis is accelerating.
It's loss of faith ultimately that destroys the capacity of these media of exchange from functioning. And we can see globally the various markets are in action. They're not talking about it, but they're actually moving and putting structures in place. And so, we would be naive if we were to ignore these signs that these other countries are getting ready to switch over if need be, or maybe they just feel that the need is there and they're getting the structures ready to go. And they'll do it gradually with time. We don't know which of the two, but certainly we can see that things are being pushed in a precipitous direction, both geopolitically as well as financially, and we're getting numerous signals that things aren't as they have been for the last half a century or more.
Yeah, indeed. We're going to be talking to Daniel McAdams in just a few minutes, and one of the things I want to talk to him about is the supposed U.S. intelligence that shows the bad boy Putin was doing some naughty things to our friends in the Ukraine, and apparently that propaganda, true or not, is being used to try to get sanctions from Europe. But the Europeans don't want to really, why would they bet against? Why would they try to destroy their own well-being and their own trade? And I think that's what. So it's a lot of propaganda out there probably to try to keep the Europeans in line with what the Anglo-American Empire wants to do. But, it seems, David, you and I have talked about this before, wherever we go, we seem to create more chaos. And certainly that is true in the Middle East, but you pointed out that the U.S. Embassy was evacuated over the weekend in Gaddafi land. Tell us about that.
Yeah, they've pulled out of the embassy in Libya and have evacuated or left the country now. Is maybe a better way of saying it. But so we see now that that Gaddafi was killed and that the country was destabilized by NATO. As a policy choice.
Yeah.
By Europe and America, and they went in there and destabilized that country and. We're actively cooperating with groups like Al Qaeda in Benghazi.
Yeah.
And now that they've evacuated the U.S. embassy in Tripoli, and basically we've seen that there's another example here of chaos being brought to a country that wanted to steer away from the petrodollar.
Yeah, it's just chaos seems to be if it's not the goal, it certainly is the result of everything we're doing everywhere we go with our military. And it just seems totally, almost as if, almost satanic, I would use a word like that. It's chaos. It's just total disorder. And what good can come of it? I can't figure it out.
Well, it may be that when you have a problem, if everybody else around you has great problems as well, it makes your problem a little bit more manageable.
Yeah.
Right, and you don't stand out as being an exception in that case.
Yeah. So let's say if the markets are so distorted, they're so rigged, they're so not free, that if we see all of a sudden the gold price taking off like mad, because suddenly people lose confidence in the dollar, we can blame Putin or somebody perhaps, or chaos or whatever, instead of looking at the problems that we ourselves have created with this massive money creation over the last decades.
Yeah, you just say they were desperate times, and a number of things went wrong, and everybody had difficulty, and our solution was kind of a global solution. I'm waiting for the announcement of a new international trade medium. I would expect that to be the end result of all of this, but really the problem is intervention in the markets and the corruption of the markets.
Yeah, we started out. America did as a limited government country, one that believed in free markets, one that believed in order. And we seem to have gravitated towards a nation that is completely against free markets. Well, I can't say completely. I mean, as I look at the equity markets, I know that within the smaller markets there are buyers and sellers. But when you start from the top down and you distort everything, starting with money, which is 50% of all the transactions we have, everything is confusing and distorted. And of course, it's very, very few people that understand the very basic reason for the problems that we're having. I think the Austrian economists have the best grasp of it, but they've been Austrian economics have been have just been dismissed as a kook fringe. So it certainly isn't true, David, is it, that when the majority agrees on something that necessarily makes it true?
No, it's seeing that the central banks have bought $29 trillion of equities and other financial assets over the last 5 years. That should tell us something right there. It's not the real money advocates who are the marginal players. It's the people, the wizards behind the curtain who have the capacity to create capital from nothing and are stepping into the markets. And of course, the equity markets are flying when you have that kind of a bid underlying the markets at every turn. And they've basically broken the markets. And what they need to do is extricate themselves from the markets, and we need to go through a corrective phase. We need to restructure the debt markets, and we need to restructure our currencies. But nobody is willing to admit that and to step up and make the hard choices. Yeah,
well, it's unfortunate, but then what we have to do for ourselves and our families is what then? I guess we need to stay out of debt. That's what I think is the number one thing. Stay out of debt. That gives the government and other people less of a claim. Of course, it's hard to do that. If you own a home, you've got to pay your taxes. You've got to pay your property taxes. It's very difficult to completely protect yourself. You want to have something that's really valuable as a medium of exchange that will retain its value. So we saw, say, gold and silver, and I don't know. I mean, I'm owning mining stocks. I don't know. If things really blow up, what good will they be even?
Yeah, the wealth of the average American has dropped 36% in the last 10 years. So we can see that the net worth of individuals is declining. At the same time that the markets are being sent on an ever upwards trajectory, and people are carrying an enormous amount of debt at the middle and lower class level, as well as at the corporate level for that matter. But we can see the unsustainability of the structure, and I think that the key here is to keep your focus on things that don't carry debt, that have real value over the long term, and position yourself with that in mind.
Right, I think that's very good advice. Just one quick question for you, David. What do you think in terms of the mining shares? I'm sure you would start out by saying keeping out of debt, own some gold and silver. What about the mining shares? Is there hope for them?
As long as the financial markets, the capital markets remain functional, I think the key here is that the total cost of mining gold in 2013 was about $1,600 an ounce, including amortization of the capex, the capital expenditures required to build a mine.
Yeah.
So the cash costs are roughly $800 an ounce, but the other costs, G&A and interest and exploration, these other things, they all add up to about another $800 an ounce.
Wow. Yeah.
So if you have a $1,600 an ounce cost of net cost of production, no new mines are going to be built, and you would expect your equities to underperform.
Right.
So, I would expect that the stocks would do well at some point, and they may do well with a bang, with a reset of the gold and silver prices. But if you want an undervalued asset, that certainly is the space. The challenge here is the fact that these assets are dependent on functionality of the capital markets.
Right.
And the capital markets themselves have been destabilized. So it's a very difficult thing. But, as far as equities in general, they are the more attractive equities to be entering into now, if that's the question.
Yeah. Well, thank you very much, David, once again for sharing your insights. I look forward to talking to you again next week.